over time, I have seen that most entrepreneurs or most business persons, they tend to say, my business is profitable. But when you dig deep into the operations of the business, what we notice is that they really do not understand how revenue comes up and how the cost and all of the other operational expenses of the business should be factored in before they arrive at profits. Misleadingly, they always run with the assumption that the business is profitable, when in actual fact, what they are actually calling profit is cash flow. The moment they see money running into the bank account of the company, or they are not struggling to spend for anything in the business, the assumption always is that my business is profitable. What is an income statement? Simply, an income statement is that financial statement that helps you to track the revenue the company makes, the expenses the company incurs, and how the two eventually leads to profit or loss for the business over a certain period of time. Anytime you pick an income statement of any company, the first thing you need to look at there is revenue. That is very critical. Every business model must make money somehow. And, in economic terms, we always think about revenue in terms of price times quantity. But revenue as a top line in the financial statement of any business, it is showing how much you are making from business trade. Whether you're selling goods or whether you're rendering services or you're making money from other sources, it is the top line. It is what tells you how much of money is this business making? What are we selling? And how much are we making from selling something? That is the revenue. Another thing that comes under the income statement is what they call the cost of goods sold. If I am selling something or I'm rendering a service that is giving me revenue, what are the costs of making that revenue? And that is all what is embedded in cost of goods sold. If you think about all the logic of making revenue, you can think about material, you can think about labor, you can think of all the costs. But eventually, you need to be able to get what is called the gross profit. And the gross profit is also what you use to get the gross margin of the business, which is just that gross profit divided by revenue. But if you do not know the cost of rendering all the services or for selling the goods, you will not know the difference between that cost and the revenue, which gives you the gross profit. When you go down the line in a financial statement, in the income statement particularly, you will also see some other thing called the operating expenses. And this is where businesses get it wrong. If you think about all of these costs, marketing, salaries, rent, and all the other expenses you incur in running the business, transport, all of that gives you the operating expenses. And by the time you minus those operating expenses from the gross profit, you eventually get the net income. But that will be net income before you pay taxes. And if you pay taxes from that net income, if you make income, you will eventually have net profit. This is the bonus point. You have assets. The asset is going to be reducing in value. You also need to be looking at what is the reduction in value. What does it mean every year? You put that also as part of your expenses. Anybody, any entrepreneur, every business leader that says, hey, I am making profit, I assume that you understand what an income statement looks like. And if you do not understand what an income statement looks like, do not confuse cash with profit. That is a very common error. I'll see you again in my next video. Take care of yourself. Bye.